Good afternoon. We'll start in another couple of minutes. Good afternoon, everyone. Thank you for joining us on a Saturday afternoon to discuss about how to give an investment comeback. Right. So we have all seen comeback in terms of movies or even in terms of cricket. Right. What happened in 2018 was a phenomenal season for CSK, and what happened last year in terms of the T20 World Cup. Right. So that was a comeback after what happened in 2023. Now the markets have been quite volatile, and our portfolios would have felt it. Some of our portfolios are in red if we started out, let's say, last year when the markets were expensive. And even for some of us who have been building wealth, the returns might have come down. So now, how shall we make ourselves ready for an investment comeback when the market recovers? The market has recovered a little bit already, but if it recovers further from here and if it's more volatile, how will we keep our portfolios ready for a comeback? Is what we're going to be discussing in today's webinar. So we'll start off. To start off with, let's set the context on what is happening in Indian markets, right? So the markets in the last few months have been volatile, with April 7th being one of the biggest one day falls since June 2024 when election results were announced. Of course, the markets have recovered now, but will it continue is another question that we need to ask ourselves. So the market volatility now can be attributed to four factors, as you can see. The first one is global trade tensions, with the US President Donald Trump's reciprocal tariffs has clearly heightened the global trade tensions, right? In fact, IMF has revised India's GDP growth for the year to 6.2% from 6.5% and has cut global growth to 2.8%. So reciprocal tariffs have now been paused for all but China. However, these measures have led to a fear of prolonged economic slowdown, particularly in export-dependent sectors like IT or pharma, right here in India. Secondly, the FII behavior. So FIs have been taking money out of the Indian equity markets. With global uncertainty and stronger dollar, they are moving to safer assets. And the DIs did participate aggressively on the fall day, but they're still being cautious due to high valuations, right? Also, the corporate earnings data that's coming in for the last quarter have been weak, and the credit growth has been slow, and also the rising household debt has also led to lower consumer demand, right? And finally, currency fluctuations. Yeah, as you all know, that rupee touched 85.27 against the dollar because of the US dollar strengthening and the US recession fears, and also fewer expectations of rate cuts by Fed. Right. So a strong dollar and a weak rupee makes the Indian markets less attractive for foreign investors. So this is what is happening in the markets, and this is the reason behind why the markets have been volatile for the last few days. Right. And let's look at how investors are reacting to the market fall. So as of last month, the equity inflows dipped to 11-month low, and SIP stoppage ratio has now hit a record high of 127%. So what does the SIP stoppage ratio mean? So it indicates the number of SIP stops compared to how many new SIPs are started. So basically 127% SIP stoppage simply means for every 100 new SIPs that are registered or freshly started, 127 existing SIPs were closed. So net more SIPs are stopped than created, right? And what does this indicate? This means that the investors are pulling back from disciplined investing and are worried about the markets, or they're panicking and anxious about their portfolios, right? Now, I'm sure most of you might already be investing, so you can have a look at your portfolio and answer to this poll. So how much is your portfolio fallen from the September 2024 peak? So has it fallen by 0 to 5%, or has it fallen from 5 to 10%, or has it fallen from 10 to 15%, or has it fallen more than 15%? Okay, Shankar said his portfolio has fallen 4%. Yeah. Okay. Raja says 5%. Cool. The markets have recovered quite a bit now, right? So let's also ask another question. So now the question is to reflect on what you did in the market fall. So did you add lump sums to your portfolio whenever the market fell? That is, we saw quite a bit of volatility in February, and then the market recovered in March. And then we saw what happened on April 7th during that week when the tariff announcements were made. And then now the markets have recovered quite a bit. So there were a lot of opportunities for you to invest. Okay, Dinesh says 10 to 15%. Okay. So what did you do when the markets fell, right, in the last 4 months? So did you add lump sums and participate whenever there was opportunity to do it? Did you review your portfolio and then rebalance it? Or did you panic sell and stop your SIP, or did you not do anything when the markets fell? You can just reply in the comments saying whether you did A, B, or C. Okay, great. Cool. Some of you have reviewed and rebalanced your stock portfolio, and some of you participated in the opportunity. So I'm assuming no action is able. Okay, cool. Okay, so I'm assuming none of you panic stopped and sold your SIP. I mean, panic stopped and stopped your SIP, right? Great. So that means most of you know what to do when the market falls, right? Continue with this. So, great, cool. Yes. So most of you did the right thing. That is, you participated in the opportunity and then you reviewed and rebalanced your portfolio. And for those of whom who were not able to participate during the opportunities, did nothing, right? Which is also fine. But most of you did not, none of you panic sold or stopped at SAP, which is the right thing to do, right? So moving forward, so I'm sure all of us agree that the IPL 2018 was a very special season for all of us, right? Especially for those who support CSK, because CSK made a stellar comeback after 2 years, and what a comeback it was, right? They did go through a tough 2 years. So what did they do right in 2018 that made it the perfect comeback? In fact, if you look at it, even the 2024 T20 World Cup win is a comeback after what happened the year before. Now, how did it become the right comeback and what did the teams do right? Right. Firstly, having a plan and sticking to it. So without a plan and process in place, things tend to be all over the place, right? Both the CSK in 2018 and India in 2024 had a plan and process in place and they stuck to it. They were consistent in their performance. And thanks to this process that they set up, in fact, India did not lose even a game in the last tournament, right? That is how consistent they were. Secondly, they got their core team right. So CSK in 2018 got a lot of criticism for having a lot of old players in their team, but in hindsight, that turned out to be good. They made sure they got the right coach and brought out the best in every player, right? And they played on their strengths. They had a diverse set of players, and well, the team might not be the best on paper, but they ensured that every teammate was used effectively, and that was a winning strategy. Thirdly, taking responsibility and acknowledging. So taking responsibility and acknowledging if something went wrong, right? If a mistake is not acknowledged, or if it's a responsibility is not taken, it is bound to be repeated. So be it in cricket or investing, and this time it is different, does not work, right? Of course, both CSK and the Indian team had a strong support system, be it the coaches, the core players, the young players, the substitutes, the management, of course, the fan base, right? Without the support of them, this comeback might not have been possible. And finally, and most importantly, resilience and adapting strategies. So CSK did face quite a few challenges in their 2018 season, with key players being injured and even the venue being moved to Pune, right? Losing the home advantage, yet they were victorious. Even in 2024 T20 in the match against South Africa, if you remember, when they needed just 30 runs or 30 balls and they still had 6 wickets in hand, the match seemed over, but Bumrah and Pandya adjusted their strategies to reclaim control, and that helped us win the match. So if we remain static in our strategy, not adapting to it, winning might not be possible. So these are certain things that they got right, which helped them win or give a great comeback, right? So now look at, are we ready to make an investment comeback? See, all of us deep down want to see CSK make a comeback this season because it's not been good the first half at least. And yes, that also means that they need to win every game from here on. So we're also eyeing the strong comeback in our portfolio, right? After a solid bull run the last few years, the markets have turned volatile, and it's likely that some parts of your portfolio have dipped into red. Like we saw how much it has fallen, right? It's fallen between some of us, it's fallen 0 to 5%, some of us 10 to 15%, right? But there are signs of recovery, but this is too early. And this is a good time for us to reassess and gear up for the next phase. So where do we start? So we start with asset allocation. So the first thing is, does asset allocation really work? The answer is simple, absolutely. Why does it work? Because if you look at the asset query, you'll realize that even in the worst year, there's almost always one asset class that always holds up. In fact, 50% of the time, all asset classes deliver positive returns. Thirdly, there are no bad assets, only bad timing. So the key is to knowing when to invest in what. You can think of it like a cricket team, right? You don't play the same 11 every match. Conditions change, players go in and out of form. One season, a veteran might shine, in another, a young gun might take the spotlight, right? So the markets work the same way. So getting your asset allocation right is like picking the right player at the right time for the right match, right? So winning portfolios is about understanding the star players change every match. Well, here the assets change every year. The star asset class for that year change every year, right? So what should you do now? Firstly, indicate like how they take a strategic timeout. You need to pause, look at your portfolio with fresh eyes, understand what's performing and what's not performing. Second, review your portfolio. That is, exit the laggards. So just like a player is out of form, is benched in cricket, it's okay to let go of underperforming investments if the reasons for holding them are no longer a hold, right? Let's not hold on to losers which are fundamentally bad, right? And then backing your core. So your strongest players, like your solid mutual funds, your good quality stocks, your long-term bets, double down on them. And to get your balance right, that is how we discussed about asset allocation, right? Asset allocation is like the team composition. So you need to get the right mix of experience, aggression, and stability, even in your portfolio. And most importantly, you need to stay in the game. The markets will test you. That's how the markets work. But staying invested is how you win the long game, right? Moving forward. So again, continuing with what you should do now, the teams had a plan, right? And they stuck to it. They did not react to every ball. And markets are just like that. Volatility in the markets is like a tricky over. You need to play it smart. Let's not, don't overreact to every market move, right? Have a strategy and stay disciplined. So whether it's your monthly SIPs or your target asset allocation or your goal-based investing, just trust the process and follow it, right? And not react. Have a strategy in place, and that is much better than reacting to every market news. And also use every market dip as opportunities. So when the market gives you a short ball, don't duck. You need to add lump sum and go for the boundary, right? And adding lump sums is just like that. Also, remember that winners don't change the plan every time the pitch changes, right? They just adjust, but they stay committed, and that's exactly what you need to do for your portfolio, right? Yeah. So again, being consistent to continue your SIP and step up. So Team India or CSK didn't hit sixes every ball. So they kept the scoreboard ticking, and that's how you win long games. Your SIPs do the same for your portfolio, right? You stay consistent. Even when markets are flat or they're falling, SIPs quietly do their job, buying more when the prices are low. And also, whenever you can, step up your SIPs. So if you have got a bonus or if you've got a salary hike, step up your increase your SIP, right? So all of these small steps compound into bigger scores over time. And history shows, as you can see in the chart, right? Equity SIPs over 7+ years have historically given a good return experience, right? Long-term SIP is turned positive. So almost every 7 to 10 year SIP in equity has delivered positive returns. So it's not really about timing. It's about how long you stay invested in the markets. That's when you will start seeing good returns in your portfolio, right? And that's when you will see the power of compounding. So you don't need to hit it out of the park every month or every ball. You just keep running between the wickets, right? Stay consistent in your SIPs. Don't stop your SIP. If you can, step it up, right? And of course, every great team, they win under pressure. So they don't do that by avoiding it, but by staying composed throughout it, right? And the market is no different. Volatility is a feature, it's not a flaw and it's not a risk. So short-term swings are part of the market, it's part of the game. What matters is how you respond and now not how the market behaves. So your biggest asset in tough times like this is conviction. So when the fundamentals are intact, when you're confident about your investment decisions, the best thing to do is to staying invested, and it's also the wisest move, right? Doubt is loud, but the data and conviction is steady, right? And of course, discipline beats drama. So panic is never a strategy, and rash decisions which people tend to take during volatility, they do more damage than the volatility itself. So silence the noise and trust the process. And as you all know, every cycle has its phase. So portfolios that are built with purpose don't need constant adjustment. They just need time to grow. And volatility, of course, doesn't destroy wealth, your emotional reactions too. So let's not react. Let's just stick to the plan, right? Also, if you notice, what has helped each team win their match wasn't just talent. It was the strength of their entire support system, right? From the coach to the fans, the players to the substitutes, and even the support staff. It was their synergy that led to a historic comeback in 2018 for CSK or the T20 World Cup, right? So your investment portfolio needs a similar support system. At M2W, we are that system. So our experienced strategy team constantly researches mutual funds and macroeconomic trends to stay ahead of the curve. And our advisory team is completely transparent and deeply understands your financial goals, customizing strategies that suit your unique needs, right? So it's not going to be a one size fit all approach here. So it will be customized for your needs, for your risk appetite, and for your financial goals, right? And then there's you, the investor, right, at the center of it all. So it's this partnership, this synergy between the clients, the strategy team, and the advisors that has helped hundreds of M2W clients cross the 1 crore milestone, and many are more on the way. So we are here to review your portfolio, realign your investments to fit your goals, and give you a dedicated team that not only works behind the scenes, but is also the first to cheer, just like your fans, when you reach your milestones, right? So now that we have discussed about what you need to do to make an investment comeback, let's also look at what are some mistakes that you need to avoid, right? These some common mistakes that investors often make in a market like this. The first one is stopping your SIPs. So as we discussed earlier, many investors panic and they stop their SIPs during market corrections. But the very purpose of an SIP is to invest across market cycles. So right now is when SIPs truly work for you, helping you average your cost and accumulate more units at lower prices. Stopping them completely defeats the purpose of it, right? Second is panic selling. And equity markets, see, they're designed for the long term, right? So volatility is not a flaw again. It's a feature. Remember that markets are inefficient in the short run and they will swing between highs and lows. This is a time for you to accumulate quality assets and not exit them. However, it's also important to identify and exit laggards. When we speak of long term, we speak about holding on to good assets or good companies for the long terms, right? It doesn't make sense to hold on to losers for a very long time, right? So it's also important to identify and exit these laggards, right? The funds that do not perform or with poor fundamentals, right? So holding on to these low quality investments in the hope of recovery will only drag your portfolio further down. So the capital should work for you in better opportunities where it can compound, right? So exit these non-performers and then you can look at how you can compound your better, how you can make that money more productive for you, right? And if you've been reading the headlines, you know that it's full of negativity when the market falls, right? So in times like this, when the market is falling, you will see a lot of negative news. Just understand that most of it is meant for TRPs and sensationalism. So they're not meant for your personal financial decisions. Always remember that you're here to create wealth over the long term. So this is when having an experienced advisor by your side becomes critical, right? Someone who can handhold you through the noise with research and conviction. And that's what we do at M2W, right? And finally, inaction in trying to bottom the market, trying to time the bottom of the market, right? While panic selling is harmful, of course, you shouldn't be doing that. At the same time, inaction can also be damaging, like holding on to bad investments, right? Hoping for a turnaround. So it has an opportunity cost. So you miss investing in quality opportunities that could grow your wealth faster. And of course, there are some people who try to time the perfect bottom, right? It's actually a fool's game. Even seasoned professionals cannot predict it consistently. One time it can happen, but it's just luck, right? So waiting endlessly will only lead to lost opportunities and lower portfolio returns. So what is the solution to that? Again, having a process in place, having a good advisor, sticking to the strategy and the process, and you can sit back and watch your wealth creation unfold, right? So this is the slide on the milestones approach that we take at M2W, right? To handhold clients in creating their first crore. So we should now look at how many clients we have helped so far in reaching their milestones at M2W. yeah, I think we've come to the end of the webinar. If you guys have any question related to your portfolio or what you need to do, you can just drop in the comments and I'll try and answer. How can one know it's time to rebalance? So what you can do is, again, like how we talk about having a process in place, right? One thing that you can do is you can rebalance, have a look at your portfolio at the end of the year or maybe at the end of the financial year, and then you can see how your portfolio has performed during the year, right? That is one thing that you can do, and always have an asset allocation in place, right? Depending on your risk appetite, you might have a particular asset allocation, like let's say 50% equity, 30% debt, or 20% debt, and 10 or 15% precious metals, right? So just see when the equity markets becomes expensive, right? Somewhere around September, right? When the markets peaked or when the markets became expensive, even before that, right? You could have trimmed down positions, you could have booked profits in your portfolio because your portfolio has become risky, right? At that time, you can book profits and then move to safer parts of the market so that you can participate when the equity valuations are comfortable. So having a process in place will help you in rebalancing your portfolio. You can do it once a year, or you can do it every quarter, or you can do it when you become you don't have conviction in your ideas and then you feel that your asset allocation is skewed towards one particular asset class, right? That is something that you can do, or you can get in touch with an advisor and then they'll be able to do it for you, right? So here we track every portfolio every quarter, right, to see what needs to be done, and whenever there are opportunities, we'll ensure that you stay invested, right? And the rebalancing happens on its own. So yeah. That's right. We won't be able to time the market peak, right? That's why, like I told you, you do staggered exit, right? Just like how you build staggered position. So you can see that there is a curve, right? Be it the market peak or the market bottom. You invest across the curve, or you do staggered exit across the curve, right? It's better to most of us miss the market peak, right? So what you do is you do staggered exit. Whenever you feel that it's becoming expensive, but at the same time, you don't want to time the market, maybe first time you can exit 10% of your position. The next week you can exit, next day or next week you can exit another 10%. Right? That is something that you can do. So apart from that, nobody will be able to time the market. So it's better to be accurately, or rather, it's better to be approximately right than being accurately wrong, right? So Yeah, that happens. That's understandable. Getting confused when you review your portfolio. So you can get in touch with us, or an advisor will be able to help you, right? They'll be able to give you objective advice as to what you need to do in your portfolio. And yeah, so you can get in touch with us and we'll see how we can help you with that. Yes, sir, we can do that. We'll get in touch with you for that. Sure, sir. We'll have to look at how the financial advisor has worked with other clients. That is something that getting, I mean, testimonials from other clients is something that you can look at, and you can see, you can have a conversation with the advisor and see what their process is and how they have performed. And if you feel confident with that advisor, you can go ahead and invest with them. So I think someone from my team will get in touch with you to see how we can help you in terms of your financial needs, right? So you can talk about your complications with them, what you feel is the thing that you're looking for, and they'll be able to help you. Yeah. If there are no more questions, I think we can close for the day. Thank you guys for joining on a Saturday afternoon. Uh, we would love to come back again for another webinar. Thank you.